Sole proprietorship, the smallest and simplest type of business. Sole proprietorship, a business structure owned and run by one entrepreneur. Pros: easy to set up, control, and file taxes. Cons: personal liability for business losses. Business ceases to exist if the proprietor dies. Importance of understanding sole proprietorship. Understanding sole proprietorship helps entrepreneurs know that it's a simple option, but they're personally responsible for the business. If the entrepreneur wants full control and can handle the risks, it can be a good choice. However, they should be aware of potential liabilities and challenges in raising long-term capital. Easiest way to start a business. Sole proprietor. A sole proprietorship is the smallest and simplest type of business. It's like being the boss of your own business, and you are the only owner. Simple explanation. In simple terms, a sole proprietorship is when one person owns and runs the entire business. It's like having your lemonade stand or a small shop where you're in charge of everything, from making the lemonade or selling products to making decisions about how to run the business. Tips for success in sole proprietorship. Why they are important. Sole proprietorships are essential because they make it super easy for individuals to start their own businesses. You don't need to share ownership with anyone else, and you can get started quickly without a lot of paperwork or formalities. It's a great way for people with small business ideas to turn their passion into a real business. Sarah's cookie business. Simple example. Imagine Sarah loves baking cookies, and everyone in her neighborhood loves them too. So she decides to start her own cookie business. She sets up a small kitchen at home, bakes her delicious cookies, and sells them to her neighbors and friends. Since she's the only owner, it's a sole proprietorship. All the money she makes from selling the cookies becomes her income, and she uses it to buy more ingredients and grow her business. In summary, sole proprietorships are perfect for individuals who want to run their own business, have complete control over it, and keep all the profits to themselves. They offer an easy and straightforward way to start and operate a business, making them an important option for many aspiring general partnership. Understanding the key aspects of a general partnership. What is a general partnership? A general partnership is a business structure where two or more individuals called partners come together to run a business. Here are the key points to explain in simple terms. Minimum 2 owners, partners. A general partnership must have at least 2 owners or partners. These partners can share responsibilities, decision-making, and resources to run the business. Personal liability sharing. Personal liability sharing. One essential aspect of a partnership is that each partner shares the responsibility for the business's debts and financial decisions. This means that if a business encounters financial difficulties or owes money to creditors, each partner is personally liable for those debts. This could put their personal assets, like savings or property, at risk. Shared responsibility. The shared liability in a partnership is important because it encourages each partner to be cautious and responsible in making business decisions. They understand that their personal assets are at stake, so they have a vested interest in managing the business wisely. The benefits of a general partnership. Sharing business profits. The profits generated by the business are shared among the partners according to the terms agreed upon in their partnership agreement. This is one of the main benefits of a partnership. Each partner gets a portion of the business's success based on their ownership percentage. Profit sharing is a strong motivator for partners to work collaboratively to grow the business and make it successful. It aligns their interests towards a common goal, fostering teamwork and cooperation. Pass-through taxation. Partnership itself does not pay federal taxes like a corporation does. Instead, the profits or losses pass through the business and are reported on the individual partner's personal tax returns. Each partner includes their share of the partnership's profits as part of their own income for tax purposes. Pass-through taxation simplifies the tax process for the partnership. Since the business itself doesn't pay taxes, the partners avoid the issue of double taxation. Business profits taxed at the entity level and then again when distributed to owners, which occurs in some other business structures. Summary of general partnership. In summary, a general partnership is a straightforward business structure that allows multiple individuals to pool their resources and skills to run a business together. They shared liability, profit sharing, and pass-through taxation make it an appealing option for small businesses with a few owners. However, It's essential for partners to have a clear partnership agreement that outlines each partner's rights, responsibilities, and the distribution of profits and losses. Advantages of partnerships. Partnership summary. A partnership is a simple business structure where two or more entrepreneurs work together to run a business. That offers the advantage of easy setup and shared control. However, the downside is that partners can be personally liable for the business's losses. It's not a separate entity like a corporation. Key points. Partnership is for businesses with multiple owners. Easy to start without formalities. Partners share profits and are taxed individually potential liabilities. Personal liability for losses is a concern. Importance. Partnerships are important as they allow people to collaborate, combining skills and resources. However, partners need to be cautious about potential liabilities and have a clear partnership agreement to avoid conflicts. The teamwork aspect. A partnership is a type of business structure where two or more entrepreneurs work together to run a business. It's like having teammates in a business adventure. The good thing about a partnership is that it's easy to start, and partners can share the work and decision-making. However, the drawback is that partners can be personally responsible if the business faces problems. Partnership in a clothing store business. Example: imagine two friends starting a clothing store together. They both make decisions and share the profits and responsibilities. Easy to set up with no special formalities. Partners can work together and bring different skills to the business. Partners can share the profits. Pros: easy to set up with no special formalities. Partners can work together and bring different skills to the business. Partners can share the profits. Cons: if one partner makes a mistake, it can affect all the partners. Personal liability for business losses, which means they might have to use their personal money to cover business debts. Steps to set up a partnership. Create a partnership agreement that outlines how the business will be managed, how profits and losses will be shared, and what happens if there are disagreements. Find a partner or partners you trust and want to work with. Importance of partnerships. Partnerships are important because they allow people to combine their strengths and resources, making the business stronger. It's like having teammates who can help each other out. But partners should also be careful and communicate well to avoid problems and misunderstandings. What is a corporation? A corporation is a distinct legal entity that is separate from its owners, known as shareholders. Business as a taxable entity. Business as a taxable entity. Unlike partnerships or sole proprietorships, a corporation is treated as its own taxable entity. This means that the corporation itself pays taxes on its profits at the corporate tax rate. Additionally, shareholders also pay taxes on any dividends they receive from the corporation. Treating the corporation as a separate taxable entity is important because it allows for more flexibility in managing taxes. The corporate tax rate may differ from individual tax rates, and corporations can take advantage of various tax deductions and credits. Introduction to corporations. Board of Directors. A corporation must have a board of directors, which is a group of individuals elected by the shareholders to oversee the company's overall direction and decision-making. The board is responsible for making significant corporate decisions and hiring top executives to manage the day-to-day operations. Having a board of directors is crucial for corporate governance and accountability. The board's primary responsibility is to act in the best interest of the company and its shareholders, ensuring that the business is run ethically and effectively. Advantages of corporations. A corporation is a type of business structure that offers some great advantages, but it's a bit more complicated to set up and run compared to other types like sole proprietorships or partnerships. Advantages. Limited liability. One of the best things about a corporation is that it protects the personal assets of its owners called stockholders, directors, and officers. This means if the company gets into debt or trouble, these people are only responsible for the money they invested in the corporation, not their personal belongings benefits for big businesses. Perpetual life. Unlike some other businesses, a corporation can continue to exist even if the owners or directors change or pass away. It's like the company has its own life that keeps going. Easy transfer of ownership. Since a corporation is a separate entity from its owners, selling or transferring ownership in the company is relatively easy. Drawbacks of corporations. But as I said, there are a couple of drawbacks, more complicated to start. You need to do some paperwork like filing articles of incorporation and holding a meeting to elect a board of directors. It can be a bit of a headache. Annual reporting. You have to share some financial information with the government and the public every year. This can be a little annoying for some people who like their privacy. Double taxation. The business has to pay taxes on its profits, and then the owners have to pay taxes again on the money they get from the business. So it feels like paying taxes twice, collaborating for success and sharing the load. In the end, a corporation can be really great for big businesses because it protects the owner's personal stuff, allows for easy ownership changes, and it can last forever. But if you're starting a small business with your friends, you might want to consider other options that are simpler and have fewer taxes and paperwork. By the way, there's something called an S corporation, which is like a mix of a regular business and a corporation. Understanding limited liability. Limited liability for shareholders. One of the significant advantages of a corporation is that shareholders have limited liability. This means that their personal assets are generally protected from the corporation's debts and legal liabilities. Their liability is limited only to the extent of their investment in the company. Limited liability is a critical factor that attracts investors to corporations. It provides a level of protection for shareholders' personal assets and encourages investment in potentially riskier ventures since investors' losses are limited to their initial investment. Competitive in the market. External funding. Corporations have the advantage of raising capital by selling shares to investors in the public financial markets. This allows them to seek external funding from a large number of investors, which can be used to expand the business, invest in new projects, or pay off debts. Access to external funding through the issuance of shares is vital for the growth and expansion of corporations. It allows them to undertake larger projects, acquire other businesses, or invest in research and development to stay competitive in the market. The power of shareholders. Shareholders. Shareholders are the owners of the corporation. They own shares of the company, representing their ownership interest. Shareholders can participate in the company's profits through dividends and benefit from capital appreciation if the value of the company's stock increases. Shareholders play a significant role in a corporation's success. They provide the capital necessary for the company's operations and growth. In return, they have the potential to earn a return on their investment through dividends and capital gains if the stock price rises. Advantages of shareholder ownership. In summary, a corporation offers several advantages, such as limited liability for shareholders, access to external funding, and a structured governance system through a board of directors. These benefits attract investors and enable corporations to undertake significant projects and expand their business operations. However, running a corporation also involves complying with various legal and regulatory requirements to maintain its status as a separate legal entity. Introduction to Limited Liability Company LLC. Limited Liability Company LLC. An LLC is a type of business structure allowed by state laws. It offers liability protection to owners' members, which means their personal assets are protected if the business faces debts or lawsuits. Ownership and members. Members can be individuals, corporations, other LLCs, or foreign entities. There is no maximum limit to the number of members, and some states allow single-member LLCs with only one owner. Complying with legal and regulatory requirements. Taxes and classifications. The IRS treats an LLC differently for taxes based on elections made by the LLC and the number of members. For federal income tax purposes, if an LLC has at least 2 members, it's classified as a partnership. If it has only 1 member, it's usually treated as a disregarded entity, but it can choose to be treated as a corporation. An LLC must file Form 8832 to elect its tax classification, and there are specific time limits for making this choice. Importance. LLCs are important because they provide liability protection to business owners, which means their personal assets are safe. Unlocking the potential of corporate ownership. It's a popular choice for entrepreneurs starting a business because it's flexible and offers tax options. But remember, each state may have different rules, so it's essential to check with your state's requirements before setting up an LLC. Limited Liability Company LLC. An LLC is a way to organize a business allowed by state laws. It's like forming a special group for your business to protect you and your friends from some big problems. Ownership and members. In an LLC, the owners are called members. Members can be people, companies, or even people from other countries. There's no limit to how many members you can have. Some states let you have an LLC with just one owner. Pros. The main advantage is that it protects you and your friends, the members, from being personally responsible if something bad happens to the business. It's like having a safety shield around your personal stuff, like your money and belongings. Cons. Some businesses, like banks and insurance companies, can't be LLCs. There are some rules to follow, and each state has its own special rules, so it's important to check with your state to do it right. Steps to set up. Check your state's rules. Make sure you understand the requirements for starting an LLC in your state. Choose a name. Pick a cool name for your business, but make sure nobody else is already using it. File paperwork. Fill out the necessary forms and file them with the state to create your LLC. Operating agreement. If you have other members, it's a good idea to have an operating agreement that explains how the business will run and what each member is responsible for. Importance. LLCs are important because they protect the members from being personally responsible for any bad stuff that happens to the business. It's like a shield that keeps your personal stuff safe, but you need to follow the rules and do things correctly to have a strong and safe LLC. S corporation, a hybrid option. An S corporation is a special type of corporation with some tax benefits. It's like a friendly corporation that enjoys certain tax advantages, but it has specific rules to follow. Combines elements of a regular business and corporation, offers the advantages of a corporation with certain tax benefits, pass-through taxation, avoids double taxation by passing income to shareholders, limited to 100 shareholders, suitable for small to medium-sized enterprises. Considerations for small businesses. Imagine a small family restaurant that is a corporation that wants to be an S corporation to pay fewer taxes. They meet the special rules and now enjoy the tax benefits. Pros. Enjoy tax benefits like a partnership or sole proprietorship. Limited liability for owners. More credibility and status as a corporation. Cons. Must meet specific eligibility requirements. Some restrictions on the number and type of shareholders. How to set up. First, set up a regular corporation. Then, meet the S corporation eligibility criteria and file the necessary documents with the 3. IRS. Importance. S corporations are important for small businesses because they offer tax advantages similar to partnerships or sole proprietorships, but still provide the protection. How to set up. First, set up a regular corporation. Then, meet the S corporation eligibility criteria and file the necessary documents with the IRS. Importance. S corporations are important for small businesses because they offer tax advantages similar to partnerships or sole proprietorships, but still provide the liability protection that corporations have. In conclusion, the different forms of business organization offer various options for people to start and run their businesses. They allow individuals to pursue their passions, friends to work together, and businesses to grow while enjoying specific benefits and protections, managing the principal-agent problem. Ensuring alignment between principals and agents. What is the principal-agent problem? Each form serves a unique purpose, and people can choose the one that best fits their principal-agent problem. Imagine you are the boss of a company, and you hire someone to manage a part of the business for you. You are the principal because you own the company and want things to run smoothly. The person you hired is the agent because they work for you and manage things on your behalf. The principal-agent problem happens when the agent might not always make decisions that are best for you and the company. This misalignment of interests is called agency conflicts or the principal-agent problem. Wrong decision-making power. Simple example. Let's say you hire a manager to run a video game store for you. You want the manager to sell the best video games to make more money. But the manager decides to sell video games they like personally, even if they are not the most popular ones. This can create a problem because it might not bring in as much profit as you hoped. Pros of the principal-agent relationship. Pros. Agents can use their skills and knowledge to handle tasks you might not have time for. Principals can focus on other important aspects of the business. Cons. Agents might prioritize their interests over yours. There could be a lack of alignment between what you want and what the agent does. Why is it important? Agency conflicts can lead to problems in a company, like managers making decisions that only benefit themselves, not the owner's shareholders. To avoid these conflicts, companies use control systems to make sure managers' incentives are aligned with the owner's interests. This way, the store can run smoothly and everyone involved can benefit. Examples of agency conflicts. In a big company, the CEO might focus on making decisions that boost their pay or prestige, rather than doing what's best for the company and its shareholders. A politician may pass laws that benefit their wealthy donors, even if it's not good for the people they represent. Understanding the principal-agent problem is essential because it can happen in many situations, not just in businesses. It can occur in families when parents hire a babysitter to take care of their kids. Steps to address the problem. To address the principal-agent problem, it's crucial to clearly communicate your expectations to the agent so they know what you want. Create incentives or rewards that motivate the agent to work in your best interest. Monitor the agent's actions regularly to make sure they are doing what you asked. Same goals. Have open and honest communication with the agent to discuss any issues or concerns. Importance. Managing the principal-agent problem is important because it helps ensure that people who work for you or represent you act in a way that benefits you the most. By doing so, you can avoid conflicts, build trust, and achieve better results in whatever task or situation you're dealing with. It's about making sure everyone is on the same page and working towards the same goals. 3 key parties in a company. Managers. They make important decisions for the company's success. Shareholders. They own the company and want it to do well to make a profit. Bondholders. They lend money to the company and want it to succeed so they get their money back. Why they have different interests. Shareholders want the company to take risks, to make more money, and pay them bigger dividends profits. Bondholders want the company to be more careful with its money, so they get their loan back. Managers might want to take risks for their benefit or play it safe to keep their job. Why is it important? Recognizing these different interests helps companies find ways to balance them and make everyone happy, so the business can grow and be successful. Understanding these different interests helps companies balance them, so the business can grow and be successful. Introduction to financial management. Financial management aims to increase the wealth of shareholders by paying dividends and causing the value of their investments' stock price to rise. The market value of a company is the total value at which its shares would trade in the market. Maximizing shareholder value means making decisions that benefit the shareholders and increase their wealth. Market value and investor perception. Similarly, maximizing market value means increasing the overall value of the company as perceived by investors. Corporate governance involves the roles and relationships between a company's management, board, shareholders, and other stakeholders. In larger firms with a separation of ownership and management, there's a risk of the board becoming too focused on management's interests rather than those of shareholders. Proper financial management involves agents' management working to benefit the principal's shareholders by increasing their wealth through dividends and increasing the stock price. Strategies for wealth maximization. However, the sole concentration on maximizing shareholder value has been criticized because it may ignore the welfare of other stakeholders and lead to short-term decision-making that harms long-term shareholder value. Different models of corporate governance exist worldwide, with the Anglo-American model emphasizing shareholder interests. In simple terms, financial management's goal is to make shareholders wealthier by increasing their investments' value through dividends and stock price growth. Maximizing shareholder value and market value are essential for financial success, but it should be done responsibly, considering the interests of all stakeholders for long-term sustainability. Understanding agency costs. The impact of misaligned interests. Simple explanation. Agency costs occur when the person in charge of a company, usually the manager, doesn't work in the best interest of the companies. This happens when ownership is separated, meaning the shareholders don't directly manage the company, and managers have their own goals that might not align with making the most profit for the shareholders. Such conflicts can lead to problems within the company and hurt the shareholders. Mental model. Simple explanation. Imagine you have a group project at school and you're the owner of the project idea shareholder. You choose a classmate to lead the project manager. Now, if the manager starts doing things that benefit themselves more than the project's success, like taking credit for all the work or doing something unrelated to the project, that's like agency costs. Good project governance. Good project governance would be having clear rules and transparency to make sure the manager works in the project's best interest. Example exercise. Scenario. You and your friends start a lemonade stand business. You own 50% of the business, and your friend Alex owns the other 50%. You both hire a manager, Sarah, to handle the stand while you're in school. Identify whether each situation leads to agency costs or not. Sarah buys fresh lemons to make better lemonade and attract more customers. Not agency costs. Benefits the business. Sarah takes the money from the lemonade sales and buys herself a new bike. Agency costs. Benefits. Sarah regularly shares the earnings and expenses report with you and Alex. Not agency costs. Transparent and benefits. Both owners. Sarah hides some sales to keep more money for herself. Situation analysis. Agency costs. Hiding sales to benefit Sarah. Simple components. Agency costs. When managers' decisions don't benefit the owner's shareholders due to ownership separation or conflicting interests. B. Corporate governance. Rules and practices to ensure managers act in the owner's interests. Good project management. C. Shareholders. Project owners who choose a manager to run the business like team members. Managers' objectives. Managers may have personal goals that differ from the owner's profits, like working on pet projects. E. Transparency and disclosure. Being open and honest with owners about business decisions, sharing reports. Advantages and disadvantages. Advantages. Lower agency costs lead to better decision-making, benefiting the company and its owners. Good corporate governance attracts investors and builds trust in the company. Transparent practices create a positive reputation and improve relationships with stakeholders. Disadvantages. Implementing governance measures can be costly and time-consuming. Focusing only on shareholder value may neglect other stakeholders' interests. Shareholders might not always have enough expertise to guide managers effectively. Understanding this helps companies maintain trust with shareholders, make better decisions, and build a sustainable business. It also safeguards against costly scandals and losses due to mismanagement. Maximizing value for shareholders vs. considering stakeholders. A look at agency costs. Stakeholders and their importance. Stakeholders are individuals or groups who can be impacted by a business, both inside and outside the company. They include owners, employees, customers, suppliers, the government, local communities, and the environment. Financial management aims to maximize a company's value, but there are debates about whether it should be done without harming stakeholders. Corporate governance involves making decisions about how a company is run and who it benefits, and the debate revolves around whether companies should focus solely on maximizing value for shareholders or also consider the interests of other stakeholders. Stakeholders vs. bondholder. Considering stakeholders can benefit everyone involved and is linked to market value. Shareholders prefer riskier projects as they seek higher potential returns, diversification of their portfolios, and long-term growth. Bondholders, as lenders, prefer safer projects to ensure the stability of income and lower default risk. Understanding agency costs in corporations. Implications for shareholders and managers. What are agency costs? Agency costs occur when managers of a company don't work in the best interest of the shareholders. These costs mainly happen when ownership is separated and managers have their own goals instead of trying to maximize profit for the shareholders. This conflict can lead to problems within the company and hurt the shareholders. Importance of business valuation. Business valuation refers to the process of determining the economic value of a corporation based on various factors like financial performance, assets, liabilities, growth potential, market conditions, and industry comparisons. It is crucial for making informed investment decisions, selling or acquiring businesses, and attracting potential investors. A corporation's connection with the financial markets allows it to raise capital by issuing shares or selling bonds. Publicly traded corporations offer liquidity to investors, allowing them to buy or sell shares easily. The stock price reflects the market's perception of the company's value and performance. Principal/agent problem in corporations. The principal/agent problem arises due to the separation of ownership and control in a corporation. It occurs when the interests of shareholders and managers don't perfectly align. Corporations use detailed contracts to align the interests of managers with those of shareholders, ensuring accountability and improved decision-making. Understanding the roles of shareholders and bondholders is essential for making informed financial decisions. Shareholders have ownership stakes and voting rights, while bondholders are lenders who receive fixed payments. Both play crucial roles in a company's capital structure and financial stability.